HA Commissioner Julia Gordon. Thank you all very much.
Just thrilled and honored to have Julia Gordon with us. She is the Assistant Secretary for Housing and the Federal Housing Commissioner at the U.S. Department of Housing and Urban Development. Throughout her career, Ms. Gordon has been both a strong advocate for and a hands-on practitioner working to achieve equal housing justice, fairness, and equity in housing and consumer protections. I know this because I've worked with you in about half of your jobs, and that is absolutely true. As Assistant Secretary for Housing and Federal Housing Commissioner, Commissioner Jordan is responsible for HUD's policies, programs, and operations supporting the nation's homebuyers, homeowners, renters, and communities. She is responsible for the Federal Housing Administration's single-family, multifamily, and healthcare mortgage insurance programs currently serve more than 7.5 million homeowners and 1.5 million renters, as well as 4,000 healthcare facilities across the United States and its territories. In addition, Ms. Gordon is responsible for HUD's multifamily assisted housing portfolio, which serves more than 1.2 million low-income residents, the administration of HUD's housing counseling program, and the development and oversight of federal standards for the design and construction of manufactured homes. Now, I really appreciate you coming here because I know you're working 22 hours a day. Prior to joining HUD, Commissioner Gordon was most recently the president of National Community Stabilization Trust. That's where a policy person goes to get mud on their boots, and where she was a passionate advocate and leader for housing equality and neighborhood investment, launching multiple new initiatives supporting neighborhood stabilization and affordable housing. From 2013 through 2015, she was the senior leader at the Center for American Progress, where she led the center's work to address access to affordable homeownership and rental housing and safe financial products and services. And previous to that, she had leadership roles at
way too long.
FHFA and CRL, because I only mentioned the ones I was really impressed by. So, and then finally, Julia received her bachelor's degree from what Charles and I fondly call the Michigan of the East, also known as Harvard University. So thank you for being here. So let's jump right into it. FHA and racial wealth gap affects Black homebuyers. It affects really all minority homebuyers, AAPI, Latino. FHA loans have always been a core product for this community. Tell me a little bit about what you've been doing in this space since you've taken over.
So good afternoon, everybody. Delighted to see a room pretty much full of friends. To the two of you I don't know yet, hi. We can get to know each other after. And just so you know, I'm bringing up notes with me, not because you can't like wake me up in the middle of the night and hear this speech, because you totally can, but because we've done so much on this issue, I don't want to, leave anything out. So I bring the little bullet points just to remember. And, I would be remiss if in a room like this, I did not say that the vast majority of what I know on this topic, I have learned from somebody in this room. I just saw Nikitra walk in. She was one of my early teachers on these issues, and Ricardo and Charles, and there's just a lot of us go way back. And so when I was thinking about working in the administration, I will be honest with you, there was no other job I wanted. I wanted this job so bad, and the reason is because I have felt like FHA's historical reputation is not accurate now, and I wanted to be at FHA so that we could demonstrate how strong and important a program this is, particularly for those of us who are here today to talk about Black home buyers, because FHA, you know, pound for pound, sort of relative to our overall book, serves far more first-time home buyers, first-gen home buyers, Black home buyers, Latino home buyers, rural home buyers than any other channel. And, you know, we're basically the original special purpose credit program. And honestly, there's a lot of people out there I think are kind of reinventing the wheel when the FHA program is now a lot more appealing, both from the perspective of borrowers and also from the perspective of lenders. So, you know, I'm really proud of FHA's presence in the market right now. Of course, as you know, it's, you know, the original low down payment homeownership product, and we are always making changes to try to be better. And, you know, look, I'm looking around this room, a lot of you know where FHA came from. FHA is turning 90 years old this year. And in the first part of that history, FHA was a product of its time and its stereotypes and its discrimination, and it played a role that was not a positive role for many of the communities and populations that we're particularly focused on serving now. And, you know, I say this not because we want to like wallow in the sins of the past or anything, but I think it's really important to look at the trajectory of something like FHA, because you see how what I'm sure at the time was considered just a risk mitigant actually turned into a real barrier for Black and many other homeowners who didn't fit a certain model to not be able to grow the assets and wealth that other families got to grow. And I say this because we see this in other areas now. Not, you know, in FHA, I'm very proud of what we're doing now. But when you look across other sectors that touch home ownership, I mean, you know, insurance or things like that that come to mind, you can see how there are decisions being made that are being justified based on risk that are exclusionary. And so I just think it's really important to learn the lessons of the past. And, you know, certainly my presence at FHA is because I feel like now FHA is doing so much to really try to make the marketplace more accessible and more affordable for Black home buyers.
And so let's talk a little bit about the specifics around that. Tell me specifically, how is FHA a better product today? And what are some of the programs that you think are doing a good job at reversing that legacy? Because it's pretty, FHA didn't invent redlining, it perfected it. So I think HOLC gets all the credit for inventing it, but it's certainly on the scale that it was used. But the maps had a long impact. So let's talk about how we turn that around.
So just in terms of the credit box, you can't beat FHA's credit box. Mm-hmm. We don't have a credit score cutoff. People think we do. You see credit score cutoffs because lenders put overlays, but we don't actually have a cutoff. And I think that's just a really important piece of what we're doing. We also, of course, are much more flexible on debt to income ratios than some other channels, and we are still successful. We are still making loans that are sustainable and maintained over the years. Our serious delinquency rate, I just got my monthly briefing this morning, and it's even ticked down a little bit in this last month. So what we're doing seems to be working with our much more flexible credit box. And then within that credit box, we're trying to be creative about making sure we're not keeping people out. I think you know when this administration arrived, FHA was counting student debt in a weird way, if I can say weird way.
That's a technical term.
That's a technical term. And we changed it so that we actually count the payment you are actually making, which seems to be the relevant one. And that is important for all of our borrowers, but for no one more than for Black borrowers who tend to have higher levels of student debt. Another thing we've done that has been really an unqualified success is begin to count positive rental history. And you can clap for that. And I will tell you, it took a while to get to that because you may know that something FHA is not on the forefront of is modern technology. And you know, there's some of you, I'm looking at Jonathan, there's some people in here who are very technology forward. And there was this idea that somehow you had to like make your technology really super modern before you could look at positive rental history. And that just clearly was not going to happen for us anytime in the near future. So we found a workaround. And the workaround is working great. Early returns from some of the evaluation that our PD&R at HUD, which does the evaluation for us, is that thousands and thousands of people are making it over that line into homeownership who wouldn't have made it before they had that plus factor. So that's really exciting. And one more thing I'll mention before I let you talk more if you want to, is that
not many people need to say that.
Just if you're ever just alone with David and me, it can be a little hard to take.
Unless you're a good listener.
Something that HUD has been leading, but it's an administration-wide effort, is what we call the PAVE initiative, which stands for Property Assessment and Valuation Equity. And this is about all the harms that have been done to communities of color by appraisals that come in low simply because of who's living in the community, because of bias. And the efforts around this, and again, these are efforts with FHA and VA and USDA and Fannie Mae and Freddie Mac. We already see the focus that we've put on this making a difference out there. We are seeing fewer words that relate to bias in the written part of appraisals. And we're making some changes so that we can make sure we know what's going on out there. One is the data sharing among the GSEs and FHA. That's, if you can't see it and you can't measure it and you can't count it, you can't fix it. So the data sharing that FHFA is really taking a leading role on is incredibly important. And then another thing is recently, in conjunction with Fannie and Freddie, we announced our reconsideration of value policies. And what this does is require all our lenders, we tried not to be too prescriptive because, Bob told us not to be too prescriptive. It requires that every lender has a process. So if a borrower thinks something has gone awry in their appraisal, particularly if they think there's evidence of bias, they can raise their hand and they have a path to get that reassessed. And we feel like that's really, really important. And so I'm going to stop there and wait for your next question to go through a lot of my other bullets.
Well, good. So let's talk a little bit about fair housing and what's happening there. And there's a complicated legacy, as we know, but there's also a more recent experience where FHA, so for instance in the 70s, in the 235 program, took so much risk that communities were devastated. And then you've got the mortgage crisis and the legacy of the False Claims Act, now discouraging lenders from being in the game, loss mitigation is so critical. And if you're going to take more risk, you have to get that right. And I know there are few people in this room who know as much about loss mitigation as you do, so let's talk a little bit about that.
Sure. So something I've said since my time at CRL is we're not here to support home buyership, right? You need to be able to sustain those mortgage payments over time. And that means getting mortgage products that are fair and that don't have features in them that are designed to fail. That means doing a thorough underwriting process so that you know a particular household is ready for home ownership. And that means understanding who you're serving. At FHA, we're serving primarily first-time home buyers. And what that means is these are people with less experience. We serve lower income borrowers. As I said, we serve lots of borrowers of color. And what that means is you have to have ways to help along the journey. It's not just get someone in a home and you kind of walk away and don't have anything else to help, because this borrower population is going to encounter financial hardship. They are going to encounter fluctuations in income. They are going to encounter all the exogenous events that affect all of us, like, you know, pandemics and stuff maybe we wouldn't even have thought of some years ago that can happen. And it is so important to have a robust servicing system in place. And what we've seen since the financial crisis, when millions of people lost their home to foreclosure, who should not have lost their homes to foreclosure for many different reasons, both because they were put into bad products and because there was servicing that was not helpful. What we've seen since then is a real sea change in loss mitigation and in the ability of mortgage servicers to provide, to act as if the folks they've always called their customers are actually their customers, and to provide that assistance. And you see this across the industry now. Again, you know, Fannie Mae and Freddie Mac, but I think nowhere more than FHA do we have more options built into our program to help borrowers who face either a temporary or a permanent reduction in income stay in their home. And the pandemic experience was truly a field test, a real stress test of that system. Had things really changed from 2008? And what we learned is yes, things have really, really changed. And the measures that the government put into place across all the mortgage channels, the CARES Act forbearance, which FHA and the GSEs kind of came out with even before the CARES Act passed, the forbearance, and then what we call the COVID loss mitigation waterfall for when people are coming back into mortgage performance after their forbearance, have been incredibly strong. At the height of the pandemic, or the height of the kind of recession caused by the pandemic, FHA had almost 12% of its portfolio delinquent. You could have looked at that and said, oh, there goes FHA again.
No, it was extra special. I was a Treasury, and we were seeing records of loans that were 1,200 days late. I'm like, the guy who's 1,200 days late is not answering his door to somebody who says, hey, we can cut your payment by 20%. So
the reason we had such high levels of delinquency is we had allowed so many people to take forbearance to try to ride out the pandemic. And this worked. This worked beyond, frankly, beyond my wildest dreams, that we would have been at that level of numbers of people taking forbearance or not even taking forbearance. Mm-hmm. And to come now just a few years later and have our serious delinquency rate be below pre-pandemic levels, that is truly a successful program that basically allowed people with these loans when we were all terrified during the pandemic and people had relatives dying or they were sick themselves and they were losing jobs, and we were also terrified we were doing things like wiping down our groceries. And the one thing we didn't have to worry about was paying our mortgage. And that gave so much comfort to the homeowners of this country. And they paid that back by showing up and going back to paying their mortgage afterward. And we showed that a streamlined approach to loss mitigation could really work. We cemented the data we had from the financial crisis, that what really helps a borrower go back into performing status and stay there is payment reduction. And so FHA has learned all of these lessons and done some really innovative things in loss mitigation, but none as innovative as what we're doing now, which is the one thing the loss mitigation system that grew up after the financial crisis did not really account for was the kind of rapid and steep rise in mortgage rates that made it very hard to use what had become the standard modification, that rate term modification, and get somebody the payment reduction that was going to help them. A little bit easier at Fannie and Freddie because they had the ability to keep people at the interest rate they were already at, and so then they could adjust the term and get payments down that way. But at FHA, our servicers had to buy those loans out of the pool in order to modify them. That meant they had to redeliver at current rates. And what that meant was that rate term mod was not working for us very well at all for so many people, for people who already had a low rate mortgage. And so that's when we all put on the thinking caps, and all together, I'm looking at so many people here who were part of these conversations to figure out what we have now rolled out called the Payment Supplement Partial Claim, where FHA borrowers are allowed to use that special thing that FHA has, the partial claim, which is basically the ability to kind of lend yourself some money and use that to basically buy down your monthly payments for 3 years so that you can get through that hardship period. We have heard the very first servicer has just rolled it out in kind of record time, honestly. And we expect a bunch of other servicers to be rolling that out in the next couple of months. And we're just really excited that one of the things you get now when you get an FHA loan is this incredibly robust loss mitigation infrastructure. Sorry, that was a long answer, but I feel
no, that was great.
Strongly about it.
You're constantly at risk of segueing into my next question and then answering it before I get to ask it. So I've checked off 3 of these, but let's talk about headwinds, because there's a lot of pretty strong headwinds both in our initiative and your book of business. Mortgage interest rates obviously increased dramatically, ended up being very sticky, probably going to stay high through most of this year, if not all of it. Housing supply, critical crisis there, both for move-up buyers and especially first-time home buyers. Appraisal bias, progress, but still a big problem. And tell me about the impact of these things on the FHA market and how you're trying to mitigate those.
So volumes are down everywhere, but we do tend to be a, quote, counter-cyclical program. And so actually our volumes are not down as far as some other volumes. And it really helps that I think folks know that last year we reduced the annual mortgage insurance premium by more than 1/3.
That's
and that
one
helped make our pricing much better.
Yep.
So that's really helped people. We see people, particularly with the help of HUD certified housing counselors. We've put out a bunch of initiatives to really focus on homeownership for underserved communities. Mm-hmm. Just yesterday, I was in Harrisburg announcing a new $10 million initiative for housing counseling to focus specifically on improving how they work with populations where it's important to have the right languages, have the right culturally appropriate and sensitive approaches, and really to not just say, we're gonna just kind of take all comers into our program, but okay, we're gonna go out and we're gonna find people who we think, with the help of these counselors, can get into home ownership. I was with 2 clients yesterday on the stage, someone who was an immigrant to this country who had been here less than a year and had already been able to buy a home. And she was particularly grateful for the language assistance. And someone, a single mom from Philly, which is where I'm from, where some other people here are from, who had just bounced around to so many different places and had an 8-year-old son and has now bought a home. And that child's outcomes are going to be very, very different as a result of this. So we're really trying to be affirmative, to go out there. We've run a sort of awareness campaign called Let's Make Home the Goal, because the consultants told us that sports metaphors are good for everybody in America except for me. And we're really excited by the response to that, because look, homes are way more expensive, mortgages are more expensive, but in many parts of this country, it still is affordable to buy a home. And in many places, you're not going to spend more on your home than you spend on your rent, especially over time. You get that fixed rate mortgage, and you don't have to be at the mercy of the landlord who's just going to, jack the rent as much as they can, as often as they can.
Another technical term.
So that's another technical term. So I've heard it in technical conferences. We're really focusing on being intentional about what we're doing. I do think it's important to, note a few things that I'm going to look at my notes here and make sure that I do say. So I want to talk, you mentioned something that I really want to talk about. You mentioned the whole FCA claim thing.
For background for you,
yeah, I'll give some background.
False Claims Act, also known as the Lincoln Law, implemented during the Civil War to prevent military contractors from selling shoddy wool and lame mules to the Union Army, evolved into a major tool since 2009 that has really sought to punish lenders who've made sometimes serious errors, sometimes errors on loans that they had acquired as a result of saving another bank, and sometimes as a result of having a staple missing.
So I'm going to say this generally. This is not just about False Claims Act. When you run a government program, you have a responsibility both to the taxpayer and to the users of your program to not have lenders committing fraud. This is really important. If lenders went around and committed fraud and we didn't do anything about it, we wouldn't have much of a program left, and Congress would probably shut us down. So it is important to have rules of the road. What we have tried, and on the False Claims Act issue, during the Obama administration, FHA issued a memorandum of understanding that made it very clear that lenders would not be penalized for non-material errors by, treble damages. That memorandum, for anybody who is not aware of this, is very much still in effect. That's going to remain in effect. And that memorandum came along with a very important thing, with a very non-mellifluous name called the taxonomy, the defect taxonomy. And what that is it's FHA has put in writing the different things that can go wrong and sort of what category of error they are. You know, is this a really profound abuse of the system, or is this a foot fault? And that part of the taxonomy that related to origination has been out and working well for some time now. We are about to put out the part of that taxonomy that relates to servicing, and we hope it will work equally well. But our efforts to work well with lenders are going far beyond this question of the False Claims Act, which really is a problem of the past, I will be honest with you. A lot of the False Claims Act activity was kind of a result of the many people who engaged in wrongdoing in the run-up to the crisis and never really received any kinds of consequences for that. And so there was just the desire to go out there and make sure there were some consequences. I don't see that as the problem of the future. What I see as the problem of the future is making sure that FHA's handbook and rules are extremely clear, that there are excellent staff at the FHA Resource Center and at the National Servicing Center to answer questions, that we make it easier for lenders to engage with us, that we are fully transparent in changes we make to the FHA program. We are very fortunate to have the ability at FHA to put out, you know, rulemaking goes through the APA rulemaking process where you get to see a proposed rule and you get to comment on it, and then we have to take those comments into account and write up those comments and putting out the final rule. But for most sub-regulatory guidance, which the vast majority of the FHA program is kind of, the nuts and bolts are at the sub-regulatory level, agencies can just do stuff without asking anybody. And as someone who spent most of their life outside of government, I would see policy changes and I would be like, why did they not call me before they did that? And I'm sure many of you have had that thought over the years as well. And so what we're trying to do is use this unique ability we have to put things on what we call the drafting table, which is a place where we can informally gather public feedback on changes we're going to make to the handbook. And we can hear from consumer advocates and lenders and servicers before we put something into policy. And that has worked incredibly well over the past couple of years. Our policy making has been so much sharper and better because of it, and because of the strong relationships we've built with trade associations, consumer advocacy groups, folks that we talk to folks on the regular all the time, even when there's not something on the drafting table. And I think that right now, if I were a lender, I would be very excited to partner with FHA.
So that's a great segue into my last question, and my second to last question, which is not the softball, is on the life of a loan on MIP. So we've reduced the amount, which is great. I think it's probably at a reasonable level. 1/3 of a percentage point is a big deal. It's not a game changer, but it can make a big difference on a lot of loans. Adds up over time, but over time is the problem, right? That this stays, no matter what, no matter how much equity you have, no matter how many months you've paid your loan on time, every single month. How do we deal with that? Because that's a big difference in the execution for the borrower between you and Fannie and Freddie and many bank products.
And absolutely, and I'm going to give you a pretty fulsome answer to that, and it's everybody needs to listen to both parts of my answer. That's just like a pre-clue here. FHA mortgage, our business, we are a mortgage insurer. We are not Fannie and Freddie. We don't buy the loans. We are a mortgage insurer, and we insure that mortgage until you are out of that mortgage, until you owe zero on that mortgage. There is no time where our mortgage insurance falls off of the product. At Fannie and Freddie, when you get private mortgage insurance, that falls off, right? And then you get to stop paying for it because you're not insured anymore. But Fannie and Freddie also have another charge. It's called the G fee. It's not exactly analogous because we don't do what Fannie and Freddie do, but that G fee, which is baked into the rate that you pay for your mortgage, that is a life of loan charge, and that's what Fannie and Freddie basically get paid to do this. And so for us to drop off that insurance premium when we are still insuring you is something that is theoretically difficult and from a modeling perspective expensive. When we do the modeling that's required for a federal lending program under the Federal Credit Reform Act, which for those of you who don't know that legislation, let's just say it's no joke. We have to model things for the 30 years of that loan. So the first part of what I'm saying is our mortgage insurance isn't the same as private mortgage insurance, and you can't really equate them when you're thinking about them conceptually. That said, we live in this reality, and we know that the fact that there is a life of loan insurance premium that doesn't go down is a differentiator of our product, and not in a good way. And we also know that as a borrower's equity goes up, that they are in fact less risky to the fund. So we are looking at whether there are things we can do in this area. Again, we are an on-budget program, basically. Like, you might say, well, isn't FHA kind of like off-budget? Don't you get to make a bunch of money and spend your money? It's not how we work, actually, sadly. So we return receipts to the federal government every year. It's called a negative credit subsidy program, and we contribute to the general revenues of the United States of America. When we make changes that cause us to make less money, that has a budgetary impact, even though you don't see it in a line item. So we have to weigh all of these things as we try to look at it. But, we've in this term, we have kind of a limited time. I am hoping that our time will not be so limited and that we can continue to work on all of these great things that we're working on. And that is something that we continue to reassess that every single year.
And we may have a more fulsome conversation about that in January, one way or another. Last question. How can we do a better job of working with you to serve the purpose of the Black Homeownership Collaborative?
So I want to thank everybody here who's come into our office to talk to us. A lot of you have. A lot of you have met with us on Zoom. Especially grateful to people who actually make the trek down to L'Enfant Plaza and the historic Weaver building. It's really incredibly, raise your hand if we've done something because you came to us and told us to do something. So that happens. That is a thing that happens.
Yes, but the room has a 8 or 9 raised hands, and that never happens when we're talking with government officials. Yeah. So thank you for that.
But for those of you who didn't raise your hand, if you haven't come to talk to us, come to talk to us. We're friendly.
Just don't use a sports metaphor.
Oh yeah, well, and also we don't give you food when you come to visit us because we're not allowed to do that.
Right.
It's really important for us to hear from people working in communities with borrowers, what are the barriers that you're encountering? And are they myths or are they facts? Help us do myth busting around FHA. FHA loans don't take longer to close than other loans. FHA loans don't require that you have handrails or whatever people imagine some of the old minimum property standards are that are much more skinnied down now. FHA is a going concern. Help sellers not discriminate against FHA loans, which happens all the time out there. I don't even know why a seller should get to know what kind of financing somebody is coming with, because that's just another area where stereotyping and misimpressions can creep in. But if you see things that are true about our program that need to be fixed, come talk to us about them. Some things, people have sometimes come to me and we can literally fix something in a couple weeks. Sometimes it's, if it's a rule or something that has to go through OMB, it takes longer. But we are very responsive, and there is no more important audience in my office than the people sitting in this room today. So please come talk to us, tell us what you need, tell us how we can help you, and I'd love to get to know those of you who I don't already know.
Well, and I don't think there's been a more important and valuable FHA commissioner since I've been doing this, and that goes back to only 1984 or 1994, so thank you for that. And yeah, and I think people will be very impressed that Julie and David had a conversation that only went 10 minutes into overtime. So thank you very much.